right? Conditional trading earnings plays. So I could do the disclosure at the beginning of this, but you're already option pit people, so you already automatically signed all the disclosures. What I will tell you is that this is more an advanced type of trade, although some of the tricks are useful for all kinds of trades. Okay, mostly trading options is tricks. Okay, what tricks can you learn when the market is doing a certain thing? So the biggest problem with earnings is, I would say, that the option model was never meant to price earnings. So liquidity providers have done things to kind of trick the normal routine, or the normal pricing around earnings. So that's when a trade type, like we're going to talk about, the strangle straddle swap, and the idea kind of came. It's something I have talked to a couple of pros. Some of them have run with it, but there's a lot of things in it, I think, that are interesting from a trade point of view. So we're going to go over what it is. We're going to go over what I think are the best type of earnings trades. I'm just going to mention them because we can't cover them all in an hour. We'll be lucky to cover this. But they'll be subjects for the future. Okay. We'll talk about Apple and GE. Those are two of kind of the things that were. Apple was done by one of our pros. He does them when they look good, so hopefully I can do it as well as he can. And then GE is another example of a trade that I would call like a wheel trade. And then we'll see if Disney's an example that could work today. And I looked at it briefly and I thought it could, but we'll go through the process. And then you can see you see if the process goes. Okay. Well, I'll always do something where I have a decent risk reward, Trevor. You say, I can't believe you're doing it, never do. A couple years ago when vol was low, I actually did really well on earnings trades, just buying strangles. But I wouldn't buy the strangle there. I would buy the strangles that might be 3 months out. Because the vol was so cheap back then that you could buy things that were ridiculously low. You basically you're paying normal vol, and you got the two earning cycles with it. Right? Like one of my biggest killers was an Apple trade. Like, it was unbelievable. You could buy, you won't even believe this, you could buy the earning, you could buy volatility in Apple. It was like 3 or 4 months out, it was like 16%. I think the stock moved like 20 bucks. But anyway, so what we'll do is, what are the types of earnings plays? Right? This is kind of an ugly slide. I have to admit, this is ugly. This did not go where I want it to go. But I got really busy today trying to just close crap, so. There you go. All right. Okay. You're like, oh my gosh, look at all this weird stuff. Now, don't you like the fact that we could come up with a list of just ridiculous names for types of earnings trades? And none of them are just selling the juice at earnings. So I'll explain a couple things. So sometimes you can get a flat volatility calendar with time remaining, meaning you can buy the earnings vol and then sell options in front of it for basically fair volatility. That's almost always an edge positive trade. We used to do them more in the chat room. We've covered them off and on over time. But if you follow certain names, like right now when the market's cracking up, maybe we look at Disney, that could be a possibility, right? Let's see how, because if you think about the effect, right, I'm not gonna hit the whole thing here, but the idea is that earnings volatility is about as high as vol gets. So anytime you could sell the near term stuff for about the same vol price, that is an edge on trade. Tough to lose. I'm not going to discuss any kind of condors or anything like that today, Trevor, just what's on the list. I'm sticking to the script, okay? Ask questions about the script. All right, got too many complaints about flying all over the place. All right, on or overbid term on the date, okay? So what that means is the fact that the earnings date can change and the market really hasn't changed their date on that. So that could be another potential class for us in the future. I'm just letting you know that those earnings dates can change. So if you're going to trade options around earnings, there is that risk that the date changes. Okay. One risk that you don't have though is if you look at something like if we pull up Disney right now. Okay. So one thing you notice is, right, you have the Disney, the volatility for this week is 23, and next week's the vol jumps to 32, right? So the thing is, I think the earning is pretty much set in stone on the 6th, so nothing's really going to change about that. However, this low vol, it's hard for it to get a whole lot lower. So it can present an opportunity for very low vol purchase if you're looking for buying options or anything like that, because what generally happens is they depress volatility for all the terms prior to earnings, and all the vol goes into the earnings months. Again, this is another one. This is a subject that it's its own subject, but I just want to let you know what it is. Low volatility back month vol buy, that was what I was describing in Apple. It also happens in a lot of kind of quiet S&P 500 stocks where there's just not a lot going on in them. The vol never gets high, and sometimes you can buy back month options for very, very inexpensive prices. And if you get any kind of a real earnings flyer move, you can make pretty decent money on it. The second is the low vol momentum buy, where just, like Microsoft, we've done a bunch of that stuff before, where you buy volatility into earnings, it's not very high, or you buy the straddles are relatively inexpensive, where they can't decay very much. So anytime you can buy a straddle into earnings that can't decay a lot, that's an interesting trade. When you say back month buy, do you mean a calendar? No, neither of these are calendars. The only calendar is the top one. Basically, that when you're buying, you just buy the back month stuff, and you're letting the fact that those options aren't going to decay normally generate the edge in the trade. Right? Again, we're going to go over those in separate classes. Okay. Earnings wheel buy, we'll talk about that today. Just after earnings, usually after earnings, great time to sell puts. Depending on what's going on with the earnings, you get a little bit more room when you buy a 1/2 ratio spread. And the straddle swap on a ratio, you're like, what the frickin' hell is that? But that's what we're going to do today. Okay. So these are what I could come up with. I should say under or overbid term. Under. Okay. So again, I'm just writing the list here. These are all things that what I would recommend is if you follow a group of stocks, and I think anybody that trades options should, keep your universe relatively finite. And then when things get kind of interesting in the stocks you follow, then you have a potential option play that has high risk, low, we want high return, low risk trade ideas. It's easy to come up with the high risk trade ideas. Okay. So this was a chat in the pro chat room for Apple, right? So pro chat guys are talking. Tim put something in. He's like, I'm looking at this trade, right? I'm selling the August 2 207 strangle. I think he meant straddle, and I'm buying the August 9 He said straddle, but I think he meant strangle. The 200, 215 on a ratio. So what he was doing is he was selling the short-term options at the money, and he was buying slightly longer term out of the money options on a ratio. So if he's selling one, he's buying two, or if he's selling two, he's buying five. Now what you might, and then he said, okay, you could reprice this if you wanted to. So his rationale for this was, okay, what you're trying to buy is how much movement can I buy, or how much is this going to cost me? So if you have the chance to catch a flyer, and I think he also did a Google one which worked pretty well, where you have the chance to catch a flyer, but the cost is not really high, then this, it's like any other risk reward trade where you allocate a certain amount of dollars to and do it. Which is the earnings month? Well, this is Apple. Earnings were yesterday. I think they came out the day before on the close. So August 2 was literally that was the term right on the earnings. And the August 9 was the term after after. Right, this was Apple. I should put that up here. So Mabel's asking, when do you usually put these on? Usually within a week and in, depending. He starts pricing them, I believe, but that's how I price them. But I don't know what he does, but he seems to do it pretty well. But he is free to respond to that as he wishes. Okay. Because you don't really gain a lot by putting it on a month ahead of time. You could create it. Trevor said maybe he should do the class. I could stop the class if you want and let him do it. So the idea is, if you get a move ahead of time, you have a chance to exit. Okay? So we'll talk about the management separate from the putting the trade on, right? So I think okay, that's a good thing to add, though. Okay. So anyway, this was the idea. This went in, I think, the box on Monday. The earnings were Tuesday. Today's Thursday. And then yesterday was kind of the earnings move, and then you had the earnings after hours. Okay. So the idea is these can be done within a time frame, and because you have a certain amount of, let's take a look at how the trade sort of looks out, right? Now this is an older page of this, meaning it wasn't, I'm taking the data, but I'm looking at it today, okay? So yeah, I'm doing class. Bye. So the idea is you kind of basically what you're trying to set up is you're trying to set something up where if the earnings are kind of a bust, it doesn't cost a lot of money. Okay. Where you kind of have, okay, if the earnings kind of suck and it stays in here, even if they're sort of bad, it's not going to be terrible, right? So the idea is if the earnings are so, you don't really make very much, okay? But if the earnings are really good or really bad, you have the potential to make something, okay? And since nobody has been able to effectively uh, guess about where the earnings are going to be, um, I think that's kind of, it's a decent way. The point of it is what does the trade look like, or what is the market giving you at any particular time to do it? I think that's the key part, and then we'll discuss how that is. So what it is, you're generally selling the nearer term straddles and buying a longer term strangle. You have a ratio where you're long more contracts than you're short. It also is something you might have to trade after hours. So let's say, you know, Apple had a big after hours move, or if it does have a big after hours move. If you have portfolio margin, this could be a better trade for you because you can take the, you can manage the delta, okay, after hours. Meaning you could buy some stock if it goes down, you could sell some stock if it goes up. Like I said, it's, you have to, this is, it's not, there's nothing about this is beginner, by the way, nothing. So it is a technique you're using, possibly trading after hours. Almost every platform lets you trade after hours. And so the idea is you want to have that ability, okay? You want a credit or even for the move, meaning you put this on, once you put all the contracts together, you're trying to get a credit for the basket. Also too, you need to have a pretty large gain on a beat or miss if you go outside whatever the earnings straddle is. If you don't have, if basically if your P&L line doesn't look great, if you're moving outside the earnings, you probably are not interested in as an idea. Okay. We're going to get to that. How do you decide on the strangle strikes? We're going to get to all of that. Okay. So generally, right, what's the rule when you buy options? What's your basic option rule? Do you try to buy options as close as you can get away with to the money, or as far away from that you can get away from the money? Close. So there's nothing that's changed that. So what makes you decide on what you want to buy is how much credit you get when you sell the stuff at the money. Does that make sense? So if you're getting 20 bucks worth of credit for what you sell, you're going to take your credit and you're going to go out and buy as much as you can and see what it looks like, right? Not every earning stock is going to be good. Okay, it's not going to set up well because sometimes the market thinks the move is going to be near the money. Sometimes the market thinks all the puts are going to be bid and they think the stock's going to crash, or the market thinks all the upside calls are going to be bid, and then the strangle is not going to look very good because you're paying too much for something. Okay. So the first thing you have to do is figure out, okay, so here's a couple of this. So this were these terms and these were the prices. All right. So the August 2nd 207.5 straddle was right around $9. Let's call it $9.50. Okay. So in this case here, you had $9.50 to play with. Okay. In other words, the strangle has to cost less than the straddle. That is the general idea. So Tim's note is usually one standard deviation, right? Plus or minus from at the money, or you can use the expected move if you use toss. Okay. So here, if you have $9 to spend, how many options can you buy, right? So you go here, like, can you buy a lot of the 210s for 460? You buy a 460 call and a 460 put, and you've spent your straddle, right? Kind of tough. Here, if you buy the 212s, 335, now the 215s here are $2.30. The 200 puts here are $2.20. So that strangle's costing you around $4.50, maybe a little more, $4.60. Okay. So if you buy two strangles for $4.60, that's $9.20 against your one straddle at the money at $9.50. Do you guys see that arithmetic that I'm doing? I'm just figuring out what you can buy versus what you sell. This is the August 2 term, and here I'm looking here. So the thing is this stock is expecting, like, this could be $9, so that would be $2.16, and somewhere below that would be somewhere below 200. Okay, so the 200 puts and the 215 calls are what I would call in range, right? They're close. They're on the outside of the expected move. Would I ever pay for the position? I'm trying to think. I might have done it for even or paid like 10 or 15 cents. It all depends on how it looks, Ed. But you wouldn't pay a lot, because if you pay too much, your P&L line, it doesn't look very good if you have a move. You're basically, you're spending too much for what you get to sell, if that kind of makes sense. Basically, the idea is the bigger the credit you have, that means the stuff you get to sell near the money is a lot, and the junk you're buying out of the money is a little bit of cash. So if you're paying real money, a lot of money, that means you're getting less for the straddle and you're paying more for the strangle, right? The only way you would do that is if you thought that, you would have some huge move. Okay. So the first thing you have to do is take the closest straddle. So if you hear the earnings of the 30th, today is the 30, right? I think in the evening of the 30th, this is the last straddle you can buy. So if you want to start pricing these things, these ways, just 2 weeks into earnings. Okay, let's just start taking a look. Look at the calendar, see what's there. Tim's basically doing this as a job every day, so he's always looking at stuff. Okay, so if this strangle costs $3, all of a sudden, right, if you had $3 for the call and $3 for the put, now it's $6. So you could only buy, you would have to buy 3 for every 2 straddles that you sold. You see how more of the strangle means your ratio gets put off, Ed? Because at the beginning he said here, by August 9, 2-to-5 ratio is maybe okay, but I just want 1-to-2, meaning the more options you can buy relative to what you can sell and still try to get a credit or close to even money. I think the most I've ever seen is 3-to-1. Where you could buy 3 strangles for every 1 straddle. Right. That's basically the market's like, we don't think this thing's ever going to move, and then it moves. Okay. So are we semi-clear so far on what we're trying to achieve? So what you're trying to get is, you're trying to get the market to pay for your outside juice, for your strangle. And since a lot of you in this class have some idea, you know, the market prices things differently with every earnings and with every stock. You never know what people are going to want, what they think, right? You could have done something like this in Beyond Meat. You know, they had earnings. See how it priced. I can't remember if you priced that one or not, Tim. I think all the options were so damn expensive. I don't think it was price. It was price prohibitive. Yeah, because in that case, so if you're thinking about like a stock like Beyond Meat, what options would be real expensive in that case? If you're just, you know, if you're just kind of, you know, spitballing ideas, right? Do you think those out of the money options would be very, very expensive? Yeah, they're gonna charge you a ton for those. So it messes up the whole risk reward of the, you know, or it wrecks the potential. Because this really is, you know, you put on the trade. It's a little bit like a vol newsletter trade where, okay, I see some edge and I'm going to put it on, and then we're going to let it play out and just I'll take off the part that makes me money. There's not a whole lot difference. It's just it's a different vehicle for it. That's all. So Trevor's saying, but you wouldn't get more for the straddle. Not necessarily. Trevor, you've just spent 3 years learning about skew. And the fact that the out of the money options could have a different value relative to the at the money, can't you? 3 years of pounding that into your head. The whole part of this game is that those out of the money options can be priced exorbitantly relative to the straddle. Okay. So here's an example of the moves. So this will help give you a sense. I thought this was helpful, like on a relative sense. Okay. The intent is absolutely to hold after earnings, Dave P. But if you get a huge move in the after hours where you could sell stock against a position or buy stock against a position for the delta that you're going to get, it's my advice to do so, where you want to basically take the sure money. Because I'll show you in a minute what that looks like, okay? The whole idea is because your earnings, your risk profile is relatively small for the dollars. That's the whole point of this trade, is you're not taking massive risk dollars in this. Okay, you're taking some, right? And it's definitely an allocation thing, meaning, you know, you don't go all in with something like this. This is just a small, you know, it's a small part of your portfolio. For me, I wouldn't do more than like a 5. Well, we're going to see about delta and vega loss. It's really not a vega loss trade, Mabel. There's not a lot of vega in it. There's some, but there's not as much as you think. Because you are selling a straddle, that's pretty juicy, right? Because remember, it's a net. The whole net of the trade is not. Remember, you're not doing it for a debit necessarily. You're trying to do it for credit or even money. So the dollars you're spending are not. Right? It's not like you're buying $100,000 of the premium. So here, okay, where did the puts go, right? So here there was a put price. I believe this was the 200 puts. They basically went from $2 and change down to 50 cents, okay? And notice the vol dropped, okay? Ed G saying the options are too expensive for a straddle strangle. Could it still work for a strangle further out? It could, Ed, if the vol's cheaper back there. That would be if you go to the slides. Remember when I said there was like that low vol potential? right? Where you're pricing that strangle. That's a different class though. But yes. Also, there's a ton of pro stuff on that subject. It's just searching for it is a pain in the butt, but I have covered that in other individual sessions for people. Here is the range of the call, right? The 215 call opened around $8. Now, do you guys remember what the right? You pay like $2.50 for that call. So in this case, the after effect was pretty good, right? The call goes shooting up to $8 and you own 2 of them. Okay, so that's pretty good. And what was that? Apple was that? I think it traded 220 after hours or something like that. I think it actually made a high in the morning. I don't know if it made a high the night before. I don't think so. Right, but the idea is this call is there. All right. Now here's the thing: if the call jumps here, what do you got to do with it? Right, you're gonna have to sell it. Remember, because we'll go through it, but the whole idea is the call jumps. And when the call jumps, because you're on a ratio, what do you need to do? Right? You need to take the money, especially if the position's profitable. Because on this side, the 207 call went to 14 bucks, right? But remember, what did you pay for this strangle when you started, the straddle? You only paid $9.50 for it. And it went to 14. So this is up $5 basically once. And your $8 in straddle value, strangle value, is up to 16. I'll talk about the management in 1 second. I'm going to do the management all at once. Okay, and then Tim could type in anything, any little nuggets he's learned along the way. Okay. So the idea is you paid $5.50 and $4 for the call and the put. Okay, that's where you sold that straddle for. And the max value was $14.50, so you lost $5 once. Okay. These are all executable prices, by the way. The 200-215 strangle was $4.75. Okay. The max value of your strangle one time was $8.50. Okay. So you're in it for $9.50, but you get out of it for around 16 bucks. Okay. So you had a $6.50 gain here versus the $5 loss there. Okay. So it's profitable. So on closing, it's often useful to place pipe dream prices in the pre-market, as sometimes they get picked off in the process of matching to open the name, especially on the losing side. Okay. I think he means by the losing side, does that mean trying to buy back all your short options, Tim? So like trying to buy back the 207 puts for nothing or something like that, or the calls for a little tiny bit, right? So I think when he says losing, when he says losing side, here the strangle lost or the straddle lost, but the strangle won. Okay. Now I know this is still, so I'm going to walk through it a little bit. So what you get though is, right? Oops, I don't like that slide. How that get in there? It's all true though. How are these things come from? Okay, got that one. All right, there we go. So now here, if you think about it, here's kind of what the trade looks like. But notice what is the key part of this strategy. So this was, I took this, I guess this morning when it was yesterday morning, maybe, when Apple's trading 217, it was up 10 bucks, okay? And this was not the max value of where the trade was by any stretch, okay? Is this a kind of a lazy man's way to do a trade? It's totally not. It's not a you have to be, like I said, it's a lot like the Vol newsletter trade, right? I sold this spread, okay, written down. I just recently on a bad Amazon position sold the spread for 280 at the open. That was 10 cents a few minutes later. My advice, take the money. The easiest option advice I can give you is take the money. The difference is if we look at this, right? So let's take a look now at Apple. Here's the idea, 215, 200, right? So if you go back to, let's say the 30th, right? You have this type of position, right? Where, okay, if we move up and this is where we were, we started here and we kind of are up here, okay? If you sell 100 shares of stock at 220, okay? I want you guys just to see this, right? So this was what Tim was talking about. Okay. What happens to your downside potential there? If you sell stock, right, the stock you keep running here. Now this is different. The volatility moved around and all kinds of stuff happened. But the idea is you can, by selling out stock against this, you kind of lock in a profit on the trade and then things can slide the other way. It's possible. It's just like the same thing if the stock moved down and he bought the stock at 200. Okay. Right. So if he buys a stock at 200, he covers his 200 put, or maybe in this case, let's say it was a little better, that was like 195, right? Here's your after hours goofball purchase. And he's locking in like this upside, the fact that you got all kinds of upside there. So the fact that the stock can move away. And I think, I don't even know, maybe did Bert sell the stock or he sold out the upside call or, okay. Now here, let's take a look. If you sold your 215 call one time at $8. There you go. So if you sold this call at $8 once, okay, not two, just once, okay. Do you see how the whole side is capped? Like, it's not like you can't make any more, but you've locked in whatever your gain is for your one lot by selling the one at $8. Do you see how that changes everything just massively? Because he's locking in his profit. You know, he's got a couple $100 per contract. And now, if the stock happens to go down, it's not the worst thing in the world, right? I mean, Apple was down what, $8 today? They don't like the Chinese news. It's never good. $12 range in one day. So what the part of this strategy that makes it interesting and gives the potential is the fact that you are ratioed options. Okay. Now you can do what you want with it. Well, even if you kept some of the 215s, you did okay, Tim. The ratio provides the leverage and cheapens the entry for sure, right? And like anything, you never know what or how anything is going to happen, right? We could have a tweet tomorrow. Everything's going great with China. It's all awesome. So, Mabel, do you always use the two terms closest to earnings? The answer to that is not necessarily, Mabel, but for this strategy, I rarely find one if the strikes are too far away, because the options start getting pricey on, once you're out 2 or 3 weeks and you're trying to buy something, those options get pretty pricey. Tim says sell is always earnings week. That's the juiciest stuff. Right? So it's just, in this case though, Mabel, you want to, buying the long-term vol is much different. Here, this is much more of a, it's like, it's a skew play, it's a term structure play. Right? Because ultimately, if this thing just craps out like it did today, and we're back at the strike, okay, here are our initial prices, here's today. You didn't do anything and it ran all the way back in, you're still alive, right? It's the vol is cheaper out, Trevor, but there's like a gamma component with this. You need the options in the strangle to work. If you could buy super cheap options out there, sure. But it's also it's a function of how much you're spending on the options, right? Because the vol is going to come in on those options, don't you? Right? I mean, the thing is, you can't keep going farther and farther out because you are short that at the money. So what I would say is you have to set the credit up and see what you can go buy. And the best thing you can do is trying to purchase within the credit you get. If you venture out and spend more money, that's up to you. Right. Tim's saying conceptually you need to be in the range of the move as well. 3 weeks be cheaper, but the move may well be gone before you can close, and you can't close the options you want to close. So again, this is not a beginning strategy, but what it is a strategy when you have contracts and you have the move, right? You sell them. And when you close the contract, you see how you open up all kinds of potential for the move the other way. I mean, I have to say, today was a pretty good example of it, right? Like vol newsletter class tonight, I'm like, okay, you want to put maximum leverage on, right? Don't know what's going to happen. I was pretty convinced things were going to go lower as far as vol goes, but it doesn't matter. The only thing I was happy was, thankfully, I had some upside leverage. That's about it, because we certainly didn't go down for vol. Okay. So the idea is you're trying to use the leverage in this particular trade. Okay. So is it something you just pick and figure it out? It's mostly a lot of work for not a lot of money, Trevor, because I'm holding way too many VXX puts when I should be stopping myself on them. I'm just way too greedy with them. So I said it was a lot of effort for a couple $100. It's because I didn't stop myself when VXX started going the other way. I just figured, I'll pay for them. So, all right. So that is the strangle setup. So a couple things. So what are the things you're shooting for? So if I set up a sheet here, right? Okay, if we go, okay, what are you shooting for with this stuff? Okay. Okay. So let's say optimum setup. Okay. Is right. You want to own as many contracts as possible and still get a credit. Okay. You want to keep the term of the owned contract close as possible. Now, when I say close as possible, right, that's because close as possible gives you the most gamma. Okay. Okay. You want to keep the long contract as close to the money as possible. Okay. And we want to keep as high as possible. A positive ratio. Okay, I would say the minimum is going to be somewhere between 3 to 2. And I would say 3 to 2 is tough. It's hard to get enough upside with 3 to 2. And it can go anywhere. I've never seen anything more than 3 to 1. Maybe Tim has, but I haven't. Right? You're never somewhere in there. Okay. Okay. The key with this is, and I'm going to say Tim does this well because he's been doing well, very selective. Okay, so let's see if Disney even looks reasonable, right? Disney, I think, is next week, so let's take a look. Okay, and I am just guessing for myself here. Tim, is there any way to learn anything besides the hard way? Tim's saying if it doesn't price right, don't do it. All right, so let's look now. Well, it's hard to lose a lot on them. That's the whole point, Mabel. That's why I was trying to show you this risk profile for Apple, right? Because the amount of credit, right? Because if you think about it, if you're right at the strike here at 220, if you think about how it works, if you're right at 215, these calls are still going to be worth $2.50 or $3, right? And you're going to make a little money on this, and you're going to lose a little money on this, right? Because this, I mean, there's still a week to go for this other option. So even, but like I said here, like if you look at this, like you're long 25 Vega, right? Now this was today. this is not, I don't know if this is going to accurately reflect it, but you're not as that long. 27 Vegas when we were trading 208. Okay, let's see how Disney looks. You know, the 200 put will still be worth something. It won't be zero, but it'll be worth something. If you're right at 215, you know, but if you're at 210 or 212, you know, your straddle is toast, right? And that's the idea, because that straddle is going to contract to parity. The whole point is you want this straddle to be worth a lot or nothing. And the August 2 straddle will go to parity very fast. Like all the juice just goes out of it. That's what's important. You don't close anything before earnings unless you can get out of the whole trade for money, Trevor. You don't close the shorts. The short straddle is the thing is after earnings. That's the thing that you need to either be worth a lot or nothing. Okay. All right. Let's see how Disney. Let's see if Disney looks okay. All right. So I believe this is, so you've got 33.30. So this is your, now you see 26 ball back there. All right. So if you're going to sell the, let's call it the 142 straddle. Okay. So if you sell 10 of these, that is $5 and something cents. All right. So let's say, let's look at what the 146 is next week. Okay, maybe. I don't think they're going to give you that much. I don't think you're going to get enough, but we'll look, right? Because I can already tell you this is $5.50, and the straddle is going to cost you $4, right? So it does not look that good. Even if you buy the 147s, right? And then the put wise, we're going to do 42. And let's see here. And we're going to buy the 130. Was it 8s or 7s? All right. So we're getting worth, we're taking in, that's $3,000 worth of premium. So that's here. I'm taking in, I'm paying $3,000 or a little less than 3,000. And I'm getting 2,500. Let's see here. So it's less than 2 to 1. Let's take a look. All right. And you've got 100 Vegas with a 10-point vol drop. So you would need, all right, let's see here. I don't think you're getting enough here. $3 versus $5. You're not getting quite enough on this one. Because you're working out, okay, you know what's going to happen to volatility on this, right? Volatility is going to go down. And you're long 100 Vegas. To make your vol number, you need to be over 150. So you need to be so far outside of the range, it's hard to do it. Do you guys see that? It's pretty tough. So that it's a bridge too high on the upside. But what I want to go, it's not, is I just want to make sure you look at this and say, oh, that's not going to work. You're not quite getting it, right? All right. I'll do CVS. Okay, let's see what we get here. Let's see. Does CVS have? It can move. It got this one got Walgreens. My gosh, they're exactly the same stock. When's the date for CVS? Let's see. So it's on somewhere around the 9th. $3.20. And so unless these options are ultra cheap, this isn't going to work. I'm just telling you right now. So I'm going to look right around the straddle. So that would be around 58 bucks. Okay, 58. Because they could have a disaster earnings again, right? Like Walgreens did, and they've really suffered. So we're selling the 5/2, so the 2/2. So here, so this is $1.06. This is about even. Okay, let's see here. You're long 93 Vegas on what, a 4 or 5 point vol drop? Let's see. Can we get to? Can you get to 58 bucks? This one I think is marginal as well. You would need a 5 point move for this to pay, at least. So you would need they would need a total recovery. The way I look at this. What's the vol going to drop to on that August term? Right, because don't forget the vol goes to 0 in this term, but it's still long 93. It's slightly weighted though. So you would need, are you going to get a $4 move? That would make some money. That's possible. I don't know if I would do it a lot, but it doesn't look terrible. Because what you're looking at is, okay, if this vol drops to what number, right? So you know where this vol is going to go. All right, let's see here, CVS. So Walgreens trades at like a 20 to 30 vol, as I recall. So this is like 32. The 30-day vol will get to around 26. So you're looking at a 26 vol from, so 10 point vol drop. So this is still like, you need a bit of a move. For this one. Tim is saying lift could work. So there you go. Anyway, I wanted to run over this as a strategy. I think this doesn't look terrible. I might try it in the Walgreens. In Walgreens. Tim is saying 60, straddle in the 50, 70. The only problem is that's a long way between strikes. This is, you have like a 6 or 7% move, you can make a little money, and then you have the shot for it to go the other way. I'd say this one has a shot. Does it have really any earning surprises lately? It could. Like the bad surprise, well, that was a home run. So it can generate a little bit. The only reason you would put them on, Mike, before earnings is, what if we have another tweet tomorrow and we're down 4%? Ultimately, what's the trade? If we're down here, what do you get to do anyway? What do you get to do with your you can close the long contracts. Like, okay. You can also use this strategy with I thought we'd do this for like an iron condor, or I think Trevor mentioned like an iron, like a reverse iron condor, and iron condor before, where if you take off one side of a trade and you can manage the other side. Well, but if the price is moved, you're just taking the trade off, Michael, right? You just take the whole thing off and you're just done with the position. Well, I'll talk about the condor when it's time to talk about the condor. It confuses people to go in different directions. So that's all it is just using contracts with a condor, Ed. So that's all stuff I'm going to teach you down the road as well. Like if you put on a condor and then add a couple of contracts into it, you create the same trade. So what you're saying is, I want the vol to come in, but if we move, I want the contract. Does that make sense? And if you have the big move, you close the contract and you look for the move the other way. Okay. All right. I'm glad you came. If you like this kind of stuff, this is what like mentoring is and going through these types of things. So if you have problems with trades, you know, Mark is starting to do a little mentoring again. He's really good at working out this stuff one-on-one as well. So let us know. All right. It's on the schedule, Trevor, Friday. Be there, be square. Don't be late.